What is the MACRS calculation formula? If you have ever wondered how businesses recover the costs of their assets through depreciation, you're in the right place. Today, we will break down the Modified Accelerated Cost Recovery System, often referred to as MACRS. This method is widely used in the United States for tax purposes. It helps businesses maximize their depreciation deductions, especially in the early years of an asset's life. So, what's the MACRS calculation formula? Let's start with the basics. First, you need to determine the asset's depreciable basis. This is usually the cost of the asset plus any additional expenses necessary to prepare it for use. These could include sales tax, shipping, and installation costs. Next, you must identify the property class life. The Internal Revenue Service assigns specific recovery periods to different asset classes. For example, some assets may have recovery periods of 3, 5, 7, or 10 years. Now let's talk about the depreciation method. Under MACRS, there are two main systems: the General Depreciation System and the Alternative Depreciation System. The General Depreciation System is the default method and typically uses the double declining balance method. This means you apply a faster depreciation rate in the early years. If straight-line depreciation offers a higher deduction later, you can switch to that method. The Alternative Depreciation System, on the other hand, uses a slower straight-line method and is applied in specific cases. Once you have your method, you need to apply the convention. The half-year convention is the most common. It assumes that the asset is placed in service halfway through the year. This means you can only claim half a year's depreciation in the first and last years. There are also mid-quarter and mid-month conventions, depending on when the asset was placed in service. Now let's get to the calculation. For the first year, under the half-year convention and using the double declining balance method, the formula looks like this. Take the cost of the asset, divide it by the recovery period, and multiply by 2. Then, multiply by 1/2 to account for the half-year convention. For example, if you have a 5-year property that costs $100, the straight-line rate would be $20. The double declining balance rate would be 40%. So, for year 1, you would calculate $100 times 40% times 1/2, which equals $20. In subsequent years, you would apply the double declining balance rate to the remaining book value. If straight-line depreciation becomes more beneficial, you can switch to that method. Most taxpayers find it easier to use the Internal Revenue Service-provided MACRS depreciation tables. These tables show the exact percentages to apply each year, making the process much simpler. The MACRS system allows businesses to recover their asset costs more quickly, which can improve cash flow. By understanding the MACRS calculation formula, you can make informed decisions about asset depreciation and its impact on your financial statements.